Imagine it's 10 years from now. You log into your investment account, and you see $82,000 sitting there. No stress, no charts, no stock picking. But there's one catch. Most people make a mistake along the way that ruins the entire outcome. In a moment, I'll show you how to avoid that. Many people believe you need thousands of dollars to start investing, but that's a myth. Today, I'll show you how to build a strong investment portfolio starting with just $500 a month. No speculation, no technical analysis, just tested strategies based on data, not emotion. Why is it worth investing small amounts? This is where the magic of compound interest begins to work. Imagine investing $500 a month for 10 years. With an average return of 7%, you could build up over $82,000. And it's all thanks to consistency, regardless of market emotions. For many people, it's not just investing. It's simply a smarter way to save. ETFs are the best choice for beginners. An ETF is like a basket. With a single purchase, you can invest in hundreds of companies. You get instant diversification and low fees, often below 0.2% per year. And most importantly, you can invest with small amounts. Thanks to fractional shares, you don't need $400 to buy a whole ETF. All right, now that we've covered the basics of long-term investing, let's talk about something practical. How to build a simple portfolio with just $500 that could grow over the next 10 years. Just to be clear, here's what we're working with. We're starting with $500. Our time horizon is at least 10 years. The goal? It could be buying a home, saving for a child's education, or aiming for early retirement. The strategy is passive and long-term. No constant tweaking or overthinking. And the allocation? 80% stocks, 20% bonds. It's a classic, aggressive mix, but with a built-in safety cushion. We'll break down the $500 portfolio into three main parts. First, 60% goes to a developed markets ETF. We're using the iShares Core MSCI World UCITS ETF, ticker symbol IWDA. This fund gives you exposure to the world's biggest and most stable economies, like the US, Western Europe, and Japan. In simple terms, you're investing in over 1,000 companies around the globe, all in one move. That's $300. It's the core of our portfolio. Broad, global, and no need to overthink it. The second part of the portfolio is 20% Emerging Markets ETF. We're adding the iShares Core MSCI EM IMI UCITS ETF, ticker symbol EIMI. This fund invests in developing countries such as China, India, Brazil, and South Africa. Why include it? Because emerging markets have the potential for higher long-term growth, though that comes with higher risk. We're allocating $100 here. This is the turbo segment of the portfolio. A smaller slice, but one that could deliver a strong boost if these markets perform well. Both ETFs we selected are accumulating ETFs. That means they automatically reinvest any dividends back into the fund instead of paying them out to your account. Why does that matter? Because it allows your investment to grow faster over time. You're not just earning returns on your initial investment, but also on the reinvested dividends. It's a simple way to let compound interest do its magic, completely hands-off. And now, the third part of the portfolio. We're allocating 20% to a global government bond ETF. This is something many beginners tend to overlook. For this part, we're choosing the iShares Global Government Bond UCITS ETF, ticker symbol IGLA. It gives you access to a diversified basket of government bonds from major developed countries, including the US, Germany, Japan, and the UK. Our allocation here is $100. So, why is this important? Because bonds act as a stabilizer in your portfolio. When stock markets drop, investors often move their money into safer assets, like government bonds, and that shift helps bond prices to either rise or at least stay more stable during tough times. This part of your portfolio is designed to reduce losses and give you a mental cushion when things get rocky. It's also good to know that instead of buying a bond ETF, you can choose to invest in government bonds directly. For example, U.S. government bonds, commonly known as U.S. Treasuries. So, what's the difference between buying individual bonds and investing in a bond ETF? When you buy individual bonds like U.S. Treasuries, you know the maturity date and the interest rate from the start. You can hold them until maturity and get back your entire principal plus the interest. Of course, if you need cash earlier, you can sell the bonds on the market. But in that case, the price might be higher or lower than what you originally paid. A bond ETF, such as IGLA, works differently. It's a basket of hundreds of bonds from different countries. There's no single maturity date because the fund keeps rolling over its holdings. The price of the ETF can change over time, but you get diversification, liquidity, and convenience. You can sell at any time, just like a regular stock. These are simply two different strategies. One is more active, the other more passive. In this material, we'll focus on the passive approach. Okay, let's take a look at the allocation of our portfolio. We put 60% into developed markets by investing in an ETF that tracks the global stock market. 20% goes to emerging markets, like Asia or South America. And the remaining 20% we allocate to government bonds from around the world. And honestly, that's enough. 3 ETFs, $500, clear rules. You buy, you hold, you add more regularly. But there's one more important thing: rebalancing. That means once a year, you bring the portfolio back to the original proportions. Let's say developed markets went up, while emerging markets and bonds went down. In that case, you sell part of the gains from stocks and use the money to buy more of the assets that are now cheaper. Why do you do this? Because you're not chasing trends. You're sticking to the strategy. This way, you control risk, and you buy undervalued assets at a better price. That's it. Simple, effective, no unnecessary complications. What to expect from this strategy? Passive investing is a long-term journey. One of its most important principles is being prepared for market ups and downs. Even with a well-diversified portfolio, steady growth isn't guaranteed. Markets naturally experience declines, sometimes falling 20 to 30% during bear markets. But it's crucial to remember, these downturns are a normal part of the market cycle, which rises and falls over time. So, what does this mean for you? If you choose passive investing, you need to accept that, in the short term, your returns may sometimes be negative. That can be tough, especially if you're just starting out and watching your investments lose value. But remember, over the long run, financial markets have a strong tendency to grow. Historical data shows that broad market investments, like the S&P 500, have delivered average annual returns of around 7 to 10% over the past 50 years. This means that, despite temporary declines, investors typically see positive results over the long term. The key is patience and staying consistent with your passive investing strategy. Lower market prices aren't a reason to panic. In fact, for long-term investors, they're often a great opportunity. When ETF prices drop, you can buy more shares for the same amount of money. It's like shopping during a sale. You pay the same, but get more. This is where the power of regular investing really shows. Whether the market is going up or down, you keep making your monthly contributions. During downturns, you're buying at lower prices, and when the market recovers, those discount purchases start to work in your favor. For many investors, buying when everything is falling feels emotionally challenging. But that's exactly when long-term advantage is built, by those who have a plan and stick to it. The longer you invest, the higher your chances of making a profit. If you start investing today and stay committed to your strategy for 10, 20, or even 30 years, your odds of success are very strong. Regular contributions and reinvesting your earnings, the core of passive investing, let you take full advantage of compound interest. Even if your portfolio dips for a while, the market typically recovers over time, and so do your investments. As shown in the chart, the chance of experiencing a loss over a one-year period is about 30%. But over 15 years, that chance drops to almost zero. That's why it's so important to have the right mindset. Investing is a marathon, not a sprint. Be ready for some ups and downs. But keep in mind, long-term investing tends to deliver the best results. No matter how bumpy the road gets in the short term, history gives us every reason to stay optimistic. How to get started, step by step. You already have the knowledge, you have the motivation. Now, it's time to take action. This is your step-by-step guide to start investing passively with small amounts of money, starting from just $500. Step 1. Choose a trusted broker. Not every broker gives you access to ETFs from around the world. That's why it's important to choose a platform that lets you invest in global markets, offers low transaction fees, supports fractional shares, and is regulated with a strong reputation. Recommended broker. Interactive Brokers, also known as IBKR. One of the most trusted and global brokers in the world. It gives you access to international ETFs, low commissions, and the option to buy fractional shares. Step 2. Open an investment account. Go to the broker's website and open a real investment account, not a demo account. Then, complete the identity verification process. This is a one-time step. It usually takes anywhere from a few minutes to a few days. Step 3. Fund your account. Transfer your initial investment, at least $500. Of course, you can start with a smaller amount if your broker allows it. For example, $1 to $200. But for this guide, we'll use $500 per month as a reference point. Step 4. Choose your ETFs. Follow the suggested allocation. 60% in developed markets, 20% in emerging markets, and 20% in government bonds. Enter the ETF tickers into the platform's search bar and make your purchase according to this allocation. Step 5. Invest regularly. Set up an automatic transfer, if your broker allows it, and aim to contribute the same amount every month. You can use Excel or a finance app to track your deposits and monitor your portfolio value. And remember, consistency matters more than trying to perfectly time the market. Step 6. Rebalance your portfolio. Every 6 or 12 months, return to your original 60-20-20 allocation. For example, if developed markets have grown and now make up 70% of your portfolio, while bonds have dropped to just 10%, you sell some stocks and add to bonds. This is a key part of passive investing. You're buying undervalued assets and managing risk over time. To stay consistent, set fixed dates in your calendar, like January and July. Step 7. Repeat, and don't overthink it. Don't chase better opportunities. Don't switch ETFs every month. Just buy, add regularly, rebalance when needed, and that's it. This strategy works if you give it time. You don't need to be a genius. You just need to be consistent. Most common beginner mistakes. Mistake 1. Jumping between strategies. This is one of the most common pitfalls. You start with passive investing, then hear about a hot ETF or a magic strategy and suddenly change direction. The result? No consistency. Poor performance. Stick to one well-thought-out strategy. It works, if you give it time. Mistake 2. Panicking after early losses. Markets go down. That's normal. But many beginners panic, sell everything, and give up. In reality, market drops are part of the process, and often the best buying opportunities. Remember, you're investing for the long term. Mistake 3. Following tips from TikTok. The internet is full of self-proclaimed experts promising secret strategies. But most have no real experience or plan. Don't build your portfolio based on random videos. Stick to what's proven. Mistake 4. Owning too many ETFs. More doesn't always mean better. Beginners often think that owning lots of ETFs is smart, but it usually leads to duplication and confusion. If you already have an ETF that covers the global market, that's enough. Focus on simplicity and quality, not quantity. Stick to simplicity and discipline. The best portfolios are boring, but effective. You don't need anything fancy. Just stay consistent. Follow your plan. Be patient. Passive investing works, especially when you know when not to act. Passive investing isn't for everyone. If you're chasing quick profits, can't tolerate market drops, or simply enjoy analyzing individual stocks, then an active investing style might suit you better. And remember, you don't have to choose just one. You can always combine both approaches. Starting with $500 a month, you're not just building capital. You're building habits. You're building mindset. You're building financial independence. It's not about how much you have right now. It's about what you do with what you have. Passive investing might seem like the boring road to wealth, but boring works. Trust the process. If you found this video valuable, leave a like and subscribe. And in the comments, let me know. Are you already investing? What strategy are you using? See you in the next episode.